Hello. Hello, hello.
How are you guys doing?
Is this episode 41 or 42?
41.
41.
We're coming up on that year mark, my friends.
Yeah.
Oh, this is exciting.
That's it.
This is Topline.
This episode of Topline is brought to you by Affinity for Salesforce. Affinity for Salesforce brings powerful automations and deal-driving relationship intelligence to the Salesforce CRM and extends these insights into your email and browser. Automate the creation, update, and enrichment of Salesforce records and use your network and relationship insights to find, manage, and close more deals. To learn more, visit us at go.affinity.co/pavilion. That's go.affinity.co/pavilion. Let's do a quick check-in. AJ, you're in a good place?
I'm in a great place. I am in a very good place. We over the weekend we took our kids to an escape room.
Ooh.
And we did not escape.
Really?
We're still there.
Honestly, for anyone that has kids out there, and like we always think about this as parents, is like we don't want our kids sitting in front of YouTube or the TV all day. So we play games, like it's fun. We do family stuff, but it's tough sometimes. And to see kids in their element, it's and like thinking through it. Like there was one part where Avery was my oldest at 11. I was like working on something, trying to get numbers. I was like, Avery, get out of here. I'm working on this. Stop bothering me. I couldn't figure it out. I walked away, and then 2 minutes later, she had figured it out.
Wow.
So like, listen to your kids, everyone.
But I think the bigger you did not escape.
Yeah, it was Candyland, and we had to like figure out the secret recipe. It was like a Willy Wonka take off, and the thing that got me, which I actually am okay. This was a very hard skill. So all of the freaking puzzles led
Wait,
to like.
hold on a second. Just like you said, it's a very hard escape room. Do you do this a lot? And this is an objective judgment, or it's hard because you couldn't figure it out?
Well, I say that, but then I also looked at the record for it. It was 10.
Called Candyland. Sounds hard. Sounds hard.
So you there was this board that had like the records with the group, and like the escape nerds finished this one at 10 minutes and 42 seconds, and they have an hour, and we didn't finish it in an hour.
Wow.
So it was with my brothers. I have two brothers, by the way. I don't know if you guys
we
know
learned
that.
this recently.
Yes, I know you know this now. So Mark and Eric were there. We all went. So there was these like gumballs. I have to be now I'm thinking like, oh, Eric listens to the episode, so I got to tell the truth on this. We didn't escape. So the gumballs come out, and then you have to put them all in this thing, and the gumballs spell out the code for the lock to get out. There was no way we were going to be able to get this. So I fully admit defeat that we drowned or whatever.
You're dead. You've passed away, and this episode is a eulogy for the Bruno brothers.
AJ now. That, and then the week before I was in Austin, we had our kickoff. I dyed my beard green, which people seem to like. It's not long green
That was
anymore.
brilliant.
Yeah, it
did you
really
keep
well.
it for your board meeting, or did you shave it off?
Yeah, this is a fake beard right now. I shaved my beard. No, I have a beard now. No, I used costume paint because I had the board meeting the next day, and I was like, whatever. I didn't know how they were going to take it, so I wanted to be serious. It was a very serious board meeting.
Oh,
and I wanted to, it was one of those board meetings, very serious.
I showed people the picture. People appreciated it because it's like these are the things that one has to do. Like my uncle had done, I'll shave my head if he was a sales leader at Honda, and it was like, if we hit this number for the year, I'll shave my head. He shaved it. His hair never came back after that, though. He regrets it.
Well, I don't regret it, but I did talk to Asher Matthew yesterday, and he was like, oh, it's the guy that has the ice pod picture, and he was like kind of making dorky AJ, and I was like, well, wait a second, did you see the green beard picture? He's like, oh yeah, that was cool, but not your ice picture. I was like, how do you get to decide what my brand is? Asher, if you're listening, I decide on my brand.
Sam, how you doing?
Doing all right. I'm doing all right. I gave a kickoff, sort of like an AMA with this company Check earlier today, where I did some, had some conversation about my background in sales, my prognostications on the future. I think we'll talk about some of them in this episode, and I'm flying tomorrow to Scottsdale
There you go.
and when everybody's listening to this, the CEO Summit will have just occurred.
The best
and we will
event
be in the
ever
middle.
has just happened.
I
Yeah.
know. It's going to be pretty cool. 115 CEOs, if not more.
Wow.
Lemkin will be there. Anthony Kennedy will be there. Matt Blumberg, AJ Bruno will be there. Alina Vandenberg from Chili Piper will be there.
Bob
I think
Moore.
Adam Robinson from retention.com will be there. Bob Moore from Crossbeam will be there. It's going to be awesome.
Yeah.
So I think it's going to, I think it's going to be just what I need. There's In-N-Out Burger in Scottsdale. There's guns. I don't know if I think THC is legal. Is THC legal in Arizona? It should be. It feels like a place where
Peyote.
THC.
They're more of a peyote type of state.
Oh my God, I'm gonna definitely use some peyote.
Are you still on dry January?
That ended January 5th.
There's always next year, Sam. So then
I'm on dry Sunday. Yeah, I didn't drink yesterday.
How are you doing?
I'm okay, man. I'm okay. It's I used to play poker a lot, and you learn in poker that there are these moments where Murphy's law completely applies, where everything that can go wrong goes wrong. But the beauty of poker is you also just keep sitting on the table and you kind of get through that moment, and then it turns around and all the good luck happens in like 2 hours. You're hitting every card and it's great. So right now I'm going through a little bit of Murphy's law, but it's going to turn around and it'll be party time.
That's a good. Did I ever tell you guys how I lost my entire semester's worth of meal on playing one hand of poker when I first showed up my sophomore year?
Oh my God, you got
It
swindled.
was online poker. It was 2003, 4. It was the heyday, right, of online poker. And I played a first hand that was $500 with my roommate sitting next to me and became a degen gambler and lost all of that money and had the most sinking feeling in my entire stomach that I've ever had in my entire life.
That feeling is beautiful. Like that feeling teaches people so much. I remember walking home for 2 hours once because I couldn't afford a cab ride home and because I'd lost everything. I remember like you reflect so much on life in those moments.
Yeah.
You learn.
Yeah, it's true. Murphy's Law.
And wasn't it like 6 a.m. or something?
Always.
Like you've been
I used
playing
to
all
play
night?
like from 9 p.m. to like 7 in the morning or something. So it was always like a walk of shame. Or like a great walk, I'd be skipping home because I want a lot of money. But it'd always be when people are leaving to go to the office, I'd be like black eyes
God.
just walking by.
I have felt that extreme sadness there was this one night I'd stayed up all night in Charlottesville. This was 1999, and I'd running my record label, and we'd run out, like I was just dirt poor. And I'd hung out with this guy that was a bad influence, and I was driving home at 6 a.m. and the sun was rising. And that was the saddest I've ever been in my life.
Yeah. It's called a walk of shame for a reason, like, or drive of shame. It's really like it feels it. Okay, let's jump in. We've got some fun stuff to discuss today. So today, we're going to do a deep dive on what's happening in the late stage market in tech. We have Peter Walker is joining us next week to do a deep dive on all of tech. And I was looking at some of their data in preparation for that, and something stuck out, which was that Series E pre-money valuations are up as of Q4 of 2023. Now, these companies had a median pre-money valuation of 1.5 billion in Q2 of 2022. It dropped dramatically to 251 million in Q1 of last year. And then they're up to 708 million as of Q4 of last year. This was really timely because last week, Cowboy Ventures released an article called Welcome Back to the Unicorn Club 10 years later. They're the ones who coined the term unicorn 10 years ago in a similar article, and this was a look back on the anniversary. So here's some findings. In 2013, when they wrote this article, they only found 39 unicorns. They were looking at companies, the way they define it is companies that have achieved this valuation within 10 years of founding. So only 39 companies in 2013 were unicorns. 80% of them were consumer companies. 20% were enterprise focused. Enterprise focused companies were 2.4 times better than consumer companies from a capital efficiency point of view. And only one in a decade ever hit a $100 billion valuation. That at the time was Facebook. So in 2023, at the end of it, what do we have? We've gone from 39 unicorns to 532 in 10 years. That's a 14x increase in 10 years. 78% of them are enterprise companies, basically the inverse of 10 years ago. And capital efficiency is down. So basically, enterprise companies have the same capital efficiency as consumer companies, which is 7x right now. Basically, that means for every dollar invested to build this company, you get a 7x return. In 2013, this was 26x for enterprise and 11x for consumer. Here's the interesting part. 93% of these companies are papercorns, meaning they're privately held unicorns. That was only 36% 10 years ago. 60% of them, I love this term, zerpcons, meaning that their last valuation was from 2020 to 2022. 40% are trading below $1 billion in the secondary markets. Exits have slowed down, only 7% versus 66% a decade ago. Only 3% of these companies are public. Here's the most interesting part. So we've had this question for a while. Of all these unicorns out there, how many are going to survive? How many are going to fall in the coming months and is going to be this like event that everybody is waiting for that has to happen? Nobody knew the answer. Well, they figured this out. Of the 532 companies that are unicorns today, only 350 of them are considered healthy businesses of substance that can exist and exit. That is a 10x increase in 10 years. So, Sam, when you hear this data, just your reflection on it as you hear it, but how does that number sound to you? The 182 companies that sound like companies that might not make it. Is that number where you thought it would be, higher, lower? What are your thoughts on all of this?
So I went through the Cowboy Ventures blog post in preparation for this episode, and the main thing I thought was that the main thing I thought was that I felt like it was overly optimistic, actually. So if we I want to say she, because I think, I equate Cowboy Ventures with Eileen Lee. So I feel like it's she, but it's not just she. But they say 93% are papercorns, right? They say, I think 40% are worth less than what they most recently raised at, or is that 60%?
40%. Worth less than $1 billion right now.
Worth less than $1 billion when they were worth more than $1 billion. So 40%, and then what's the denominator? What's the total number? 530 something. So that would imply that like 200 of them are underwater, and I think 93% of them are on paper. So what I didn't understand was where they came up with that optimistic number that like 300 plus are good companies. That's what they said, right? Are solid companies. So I don't know what their math for that was. When I was also looking at the businesses that they were talking about being unicorns, I was also struck by the lack. They had cloud kitchens in there. They had DoorDash in there. They had all of these companies that are not really SaaS, actually. DoorDash isn't SaaS at all. And so I think my general takeaway was that I felt like there's probably actually fewer than the number that they said were healthy. I think that I love the Zerpcorn concept of companies that haven't raised since 2021, which of course includes Pavilion. So, probably we're worth less than we raised at, 3 years ago or whatever it may be. But I thought it was a harbinger in general, right? In general, I think the three of us on this call are running our businesses, profitably and well, and doing our best. But I think there's still a meaningful amount of pain from companies that are just upside down on their unit economics, upside down on their burn, and are not, and really to the point, predicated on economics that don't currently exist as it relates to, what the world looked like, to the point of the 40% when they last raised in 2021, 2022. And sort of to the point of what we talked about last week, which is, the need for private market liquidity. This doesn't mean that they're worth nothing. It just means that they're worth less than what they raised at. And Eileen actually there's a math example. There's an anecdote where they illustrate the problem of raising too much capital with preferences associated with it and what the outcome is for common shareholders. They do that in the blog post where they talk about a company that's raised 600 million and gets to an 8.3x and is eventually acquired for 500 million and what happens in that math. And, some people make a little bit of money, but most people lose money. And the return on that in that example is 0.8x, I believe, in terms of, valuation to equity raised. So where does that leave us? I think where that leaves us is that we're still, if you can get your, I mean, it's the same. I feel in some ways like I'm just repeating myself, but the bottom line is, if you can get your burn to a reasonable place and you have a strong balance sheet, I think you need to put aside the question of valuation for some period of time. And that's, again, we talked about this last week in the move from GAC,
You like
which is growth at any
Here we go.
to PEG, to profitable efficient growth. Well, what's the fundamental point? Fundamental point is that in that transition, see, what you're worth matters. It's the only thing that matters when you're burning capital and when you're going to need to go back and reprice your equity by raising more money. It doesn't matter that much when you're not raising money, and you won't need to raise money if your customers are in control of your business, meaning you're funding your business through revenue, than if investors are in control of your business, meaning you're funding it through, equity infusions from capital raises. All of this means, and she writes about it again. So what are like the implications? The implications are that it's not just companies that are going to have a lot of problems. The venture capital industry itself is likely too large for the amount of companies that are out there and the way that these companies are going to be run on a go-forward basis. Certainly for Pavilion, as one example, like, we're just not going to be in the business of raising any more money, except if it generates meaningful liquidity for our shareholders, which could come in any number of forms. It could come from secondary, it could come from dividends, but we're on cash flow generation mode. And, the math of particularly of multi-billion-dollar funds, which she also articulates, means if you're Andreessen Horowitz, I would love to see their, what is it, DPI or whatever the actual cash distributions
DPI.
are on money they've raised from LPs, because I bet it's not good.
Yeah.
And I bet their management fees are fantastic. And I bet that they've all made a tremendous amount of money from just accumulating as many assets as possible. But I think the industry writ large is in the middle of a major reckoning. And that reckoning is a function of the fact that valuations are just mismatched to equity, to value generation, and to the economics of all these businesses. So where does that leave me personally as a CEO? Same place I was yesterday, same place I'll be tomorrow, which is I'm trying to build my business so that if it takes 1 year, 2 years, 5 years, 10 years, I don't really care. I don't know. I think the IRR for my investors won't be 40%. Unfortunately, I think my investors are going to make money. Are they going to make more money investing in Pavilion than they would have in the stock market? Candidly, no, probably not. And that is what it is, and I'm doing my best.
Sam?
Hopefully they make more money than low yield bonds, though. Hopefully there's like a.
I mean, they're going to make something, but my point is that this is like all of the things that we talk about are interconnected, right? And like last week we talked about the lack of liquidity in private companies.
Yeah.
And why is that important? The lack of liquidity increases the risk threshold. It means that you need higher alpha to justify the investment. The more liquid we can make private companies, the lower the threshold for investing can be, which means it can be okay that I generate 1.5x or 2x what my investors invested. But if I have no opportunity to generate liquidity and valuations are depressed and my growth prospects are reduced because I'm going for efficient growth versus growth at any cost, ultimately what that means is that like the deal for everybody, including shareholders, employees, investors, CEOs, the deal on private company development is materially worse than it was a couple of years ago. And as I said before, I think the deal for me and AJ, and you, if Sales Talent Agency ever raised money, the deal for us as founders and CEOs is always going to be the best deal. But I think for employees and investors, it's not, or LPs, I'll say, if you're the Florida Teachers Union and you get $100 million to put into the S&P 500 or into a basket of mediocre VCs, I just don't know why you wouldn't put it into the S&P, which is also the point that the Clouded Futures guys makes.
So Sam, this is a bit of a side topic, but Let's say there's a founder who comes to you for some advice, and they are in this luxurious position where they get to choose which investor to take money from. A lot of time it's not a choice, right? But let's say this person has a choice. They have, on one end of the spectrum, let's say the extreme is Andreessen, and the other end of that spectrum is Benchmark, right? So this is Andreessen is large. They're focused on as many assets under management as possible. They've built all this infrastructure, etc. Benchmark is small, lean, limited infrastructure, a lot of hands-on support that you're going to get from the investors. If you're a founder and you're trying to just have the nimbleness to build the company you want to build and not have to always be under pressure from people that are telling you to build the company they think you should build, where are you going to get less of that pressure? From the large ones where you're a little cog in a big wheel and you don't matter that much, so there's less pressure, or from a Benchmark where they're really hands-on with you? Which way should you go?
Neither.
Go ahead, AJ.
Don't raise venture, I guess, is the real answer to that. Like, you have to know what you're getting yourself into. A couple of things that I'll respond to on for Sam's points, which Sam's points are very true, and it ultimately comes down to the consistent messaging that we talk about every episode. Fundamentals. It ultimately comes down to that you have to know your business, you have to know what makes it tick, and you have to know what scale looks like and what doesn't. It's really difficult to always understand that. But I think in the last 6 months, the three of us have come to that understanding of just understanding what profitability looks like inside of our business and how we get there, what the focuses are, and the most importantly, the communication to our teams on how to get there as well. I was going to ask the question though on those that like the unicorns, Cowboy Ventures thing out of the 500, whatever. You said there's 350 that are good companies. Are the 150 publicly listed?
None of them are, because
No.
93% are
Because I
private.
would love to.
I'm
One of my
like, you guys are
competitors,
done.
one of my competitors is a unicorn, and I would just love to market the shit out of that. Oh, sorry,
You
excuse
did
me.
it.
I would love to market that, and I'm only kind of being facetious and kidding. It's about what you're building for your own customers and the value there. But a lot of this just is around our ability to think of the fundamentals, think what we're working on, and what we're working towards. So
AJ,
I don't have
how
anything
many
more to say
employees
than
do you think a unicorn generally has? 1,000?
I SaaS
Yeah,
is
let's say
SaaS.
SaaS, 1,000 employees plus, right? 1,000, 2,000.
I think you would think that that's the case, but the real unicorns are there. The ones that have raised at the $1 billion valuation, I think they're like 200 to 300 employees.
Oh,
Um,
very lean.
for sure. Austin, think about it. How many
Yeah, I guess you're
pre-revenue
right. Like
companies
they
were
have.
made unicorns? They didn't have product market
Yeah,
fit.
yeah. I think
Or
that's a good
like,
point. So you can
if you
actually
were
do some
scaling at a 10,
math and say, okay, let's say the average number of employees is 500. Then if you have, let's say, 200 of these companies that are going to fall, that's almost like 100,000 people that are going to come into the market over the course of this year. That's a lot of people being laid off.
yeah, but they don't. It's like anything. I think it's a very slow burn situation. You lose,
Well,
just like anything. You lose employees over time. Not going to happen all at
but
once. I wouldn't think.
last year, if you look back, there were some really abrupt shutdowns. Like if you look at Convoy and Zoom, these were very abrupt shutdowns. So there will be a bunch of these.
Zoom is ZUME.
ZUME,
For
not
everybody
Zoom.
not.
How many employees did they have when they shut down?
I think Convoy was probably under 1,000. I think.
Yeah. Do any of the three of us know anything that went on in any of those companies? I don't
No.
personally know anything that went on
I
in
don't
those
know them
companies.
personally, but here's the question related to it. So you're going to have all of these executives. We can debate the exact number, but you're going to have thousands of people that land up in the market. And
Sure.
there's this concept around talent in tech, which is this idea of stage appropriateness, meaning that leaders have skills and characteristics that make them appropriate for a particular stage in the company's life cycle. In the research that Cowboy did, one of the things they found was that 75% of the companies that had exited had a CEO who was the founding CEO. And we've all read and heard people talk about the benefits of a founding CEO taking the company forward, product vision, all these things. And so it seems like they were able to scale, and there's all these benefits of a person scaling as the business scales. Do we need to rethink this idea of stage appropriateness, AJ? Or when you're hiring, how do you think about it? When you're hiring an executive into your company, does that come into
We
consideration? Do you think it matters? What are your thoughts on this?
we've talked about this previously, but I'm going to put a finer point on it. We talked about curiosity and being curious about the world, business, whatever. I think it just comes down to two things. It doesn't matter who the executive it is. It is knowing your product and knowing the customers and how the customers win. Like the executive, actually, honestly, I only put this for anyone coming into QuotaPath. I want them to understand the product is um as much as they possibly can. It's a complex product. So if you're coming into like HR or marketing or whatever, but it doesn't matter because it's all around the customer and how the customer wins. I've noticed a trend over the last like 2 years, and we all have had teams where we've had to make tough decisions and have the riff. We've had teams that have come on and done really well. The difference between the two, executive or not, are the ones that actually care and lean in and try to better understand what we're trying to solve, the pain points, the customer value, customer benefit, and are listening to calls, asking actively, proactively. The ones that don't, unfortunately, will most likely leave your business and are in it. So stage scale, I just don't know. I think that it goes back to the conversation we've had previously, that there's just so much change going on. I don't even know what stage scale appropriate
That's a
executives
really
look like
interesting
anymore.
point. Sam, you talk to executives who complain to you about this stage appropriateness thing because it hurts a lot of people, right? It's the reason why so many people execute perfectly in their jobs and get fired because of the great work they did, because you're now not appropriate for the next stage and we need to go find this new CRO who can do it. What are your thoughts on this idea? Like, do you think now over time, has your view changed on stage appropriateness at all?
Yeah, it has changed, but that's because I used to be a zealot about that it didn't matter at
Yeah,
all.
I remember.
And I was a zealot that it didn't matter at all, probably because I was over indexing on, not that I'm so great, but that on my history with
Your journey.
scaling,
Yeah, your own
and where
journey.
I was able to scale to 300 million, and it didn't even feel like I was doing anything special because GLG had such strong product market fit. And so my experience was like, I was at that company. We went to 300 million. I was there. Stage appropriate experience is a myth, and my position is definitely moderated
Mm.
over time. And generally, the way I would say it is, my perspective is as follows, which is somewhat tongue in cheek, but quote unquote, it cannot be everybody's first time. So
Mm.
that's what my perspective is, which
That's
is,
really interesting.
That's interesting.
it's not on an individual basis. It's the composition of the team. I think you have to look at it as a team, as an executive team, as opposed to one individual. It is the team should be a mixture of people that have relevant experience, that have been there, done that, with people that are particularly precocious, super curious, super eager, that know the customer well, or know
Mhm.
you as the founder well, and have deep empathy for you. They understand your style. They can match your style. They understand when to push back. But it can't be all of one or the other. And we were even in an executive offsite last week, and we were talking with the team about what is the voice that we're missing in the room. And we felt like, and this isn't a knock on anybody, because we were saying, what is the voice missing, not who should be replaced, but
Yeah.
what is the voice that is missing? And where we came out on it, we are missing the experienced financial operator.
Mm.
That's, we have a lot of different perspectives. We have, energy, we have customer empathy, we have bold, daring ideas, we have process people and non-process people. But we needed one more person in there to say, when I was at this big company, or that big company, or this company that's 3 steps ahead of you, this is what we did, and this is why it worked, and this is what we didn't. Not saying that we should do that here. And so my perspective is, and Travis Bryant teaches a class for CRO school on scaling from 0 to 100 million at Optimizely. So it's definitely possible. It's not a mandate, but it just can't be everybody's first time. There have to be some
That's so
balancing
smart.
forces.
I love that point. It's almost like a sports team then, right? Like you have people that
Very
are
much.
in football coming from your academy. I mean, sort of to you guys, but they come from the academy. They're super young, and you're slowly breaking them into the team. You have people that have been in this team for a long time or the sport for a long time, and together it creates a balance. I think that's sage advice. Okay, let's break. Let's dig into this a little.
I just want to hold on. I
Yeah.
just want to like that. Sam said something that was really, really important. I'm not going to like belabor the point. We can jump to the next thing of, but coming together as a management team and asking what's the gap, what's the opportunity,
Yeah,
what's missing, what do we need to do? That's a great
that's a great.
exercise to do. That's fantastic. So
That whole section.
Yeah.
good
This
takeaway,
is
Sam.
2 weeks in a row that you've said I said something really.
Look
This is great.
at that.
I know. Well, I also realized I'm going to see you in person in 2 days. So I'm just like,
When you knew that I was gloomy Gus last week and you felt a little bad, so you're being nice. Well, you know what? I appreciate your empathy. You can read the room and you've spotted it.
Good friends. Okay.
This episode is brought to you by Clary, the only unified system purpose-built to help you run revenue. Spending your Sunday nights manually inspecting deals and jotting down actions for your sellers? That's the old way. Clary's platform surfaces the insights sellers need and allows them to take action, all in the flow of work, so nothing ever falls through the cracks again. See how Clary can help you run revenue like a pro at clary.com.
So the next part is one of the findings was that only 3% of the unicorns of the last decade are currently publicly traded companies. With Carter showing that Series E valuations are up dramatically between Q2 and Q1 of last year to Q4, one has to assume that investors feel that there's some form of exit potential now, right? Because otherwise, why would you make these bets? So I looked into what the standards for going public are. And Clouded Judgment had a really interesting post on this. And what he highlighted was that let's look at 2015 to 2020 and what was considered good then. The median ARR required to go public was 200 million. The minimum was 100 million. 50% year over year growth and 120% NRR. The bar was really, really high. One of the things we have to remember is that public investors make choices between stocks, and so they have to decide that this new stock is worth more, is a better bet than with something else. And so they have really good options in the public markets right now. You have CrowdStrike, Snowflake, Zscaler. These companies grow at 30%. They have 25 to 35% FCF margins. Then you have Microsoft, Salesforce, Adobe, Meta. These stocks have been growing at a great rate. And so you have to decide why not these versus this new public company with all the challenges of a newly public company, which includes concentrated ownership, lack of liquidity, less trust with the public markets, etc. So his argument is that the bar is even higher right now. And so Cowboy Ventures highlighted that 350 of the 532 companies are healthy, but they might not be healthy enough for this bar. And so that means M&A is the desired or is the most probable outcome, right? So do you think that companies have to decide early on what type of exit they're optimizing for? Then they've been taught to do so. Generally, they say build your company and don't optimize for these things. Well, do you have to decide I'm optimizing for an M&A outcome and then building for that versus being in no man's land? AJ, how do you think about that?
I don't know about you guys, but I haven't really talked to my team about M&A in a long time. I mean, for the first couple of years of QuotaPath, first like 3 years of QuotaPath, we had a conversation. What's the evolution of a startup look like? Where I laid out the option paths of like, here's what we would need to be at in revenue for an ARR business, and this is what the valuation would look like. Then the next one, but that all got thrown out the door when we were like going through the 2020 to 21 craziness. And I just wanted them to understand what the value of their options were. And I took a step back. I'm thinking about our kickoff next week. And I was like, oh, I haven't had that conversation with them for a year and a half. Of like, what are the value of their options? And that's shame on me for waiting this long to get there. Because frankly, that's the questions that they're asking right now. And that's the demotivation that you're seeing in the general startup community of we're sitting here saying everyone's underwater, but are they? And a big piece of this, Asad, is like I had a little bit of a wake up call of saying like, oh, let me work backwards in the next 24 months. And what does it look like? And what is the world going to look like? And I started to put that down. I was like, oh my goodness, that I'm getting excited about some of these
Interesting.
things and opportunities. And so that needs to translate. And so next week, I just need to be very clear of like, hey, here's the reality of the situation. We've talked about the tough times, we've gone through the riff, but the truth of the matter is there's a lot of enterprise value here in the organization and a lot of partnership opportunity that we see. And we'll go talk about those partners and what the work that I'm doing and how the company is supporting that work. And that's what I'm really excited about. So I think this question of M&A, this question of what does it look like? Well, what you're really hearing is a lot of these funds, Series A, Series B, have looking and evaluating their portfolio and said, like, look, we either got to dump these or make something of them.
Mm,
You got 12 months. You're the partner on this deal. Figure out what this stands. I
interesting.
don't want to be having the same conversation in 12 months' time around all of these portfolio companies. And I'm sitting here saying this, and I see Sam smirking because this is like a conversation that you would have with your direct reports, not typically at a fund, but that's the conversation that's happening. It's in or out. And so founders, executives, etc., think about that. That's the conversation that's actually happening. You should make sure your CEO is having that conversation of where are we headed? What are we doing?
But don't you think that a company designed for an M&A outcome, let's say designed for private equity type of M&A outcome, or even just a acquisition by a company, that company, if you're designing for that, looks and feels very different to if you're designing for a power law outcome that your venture capitalists want. Like you would design a different company if you
You
predefine the outcome
you're
you're
creating
optimizing.
optional. I don't agree with that. You're creating optionality with your choices because the truth of the matter is, Asad, let's say things go well and like a company like QuotaPath, but not QuotaPath, designs for an outcome 2 years from now, and then has created this like large enterprise value. And then the funds can go, okay, this was clearly something that we want to invest in and it's an investable company. It's that question that Sam has asked, like, or Lemkin asked at the end of a board meeting, which by the way, I got really good feedback. We just double back on that in a second. But uh, is this an investable company? How am I doing as a CEO? Is this an investable
But
company?
that's the
And like,
difference. Like a company that a PE firm would find investable or buyable is very different to what a
Very
VC would
different.
think, right? Um, so that's the
sure,
challenge. I find that this is what I found recently. I find that
but you have to understand they're merging though. We are sitting here talking about profitability, not 300, 400% growth. You have to
Well,
understand the
okay, but that's sort of like that's sort of Austin's point, which is that there's an acknowledgement at some point that we're not going to achieve some power law outcome, and then my perspective on this question is every I only see danger if I was trying to discuss specifically we are engineering. First of all, my business is very specific. It's like a vibes business. It's a brand business. It's the membership business. So if the membership felt like we were optimizing, because your customers inevitably are going to feel what you're, should you try to optimize for some kind of outcome, your customers will feel it. And my customers will not be into feeling like they are part of an EBITDA
true.
improvement plan so that we could be sold to
Yeah.
private equity. And so I think, listen, what I know is that when we did raise money, I wasn't thinking about valuation, and I've thought about valuation more in 2022 and 2023, particularly at the beginning, when we didn't have, honestly, when my board said, at this growth rate with this burn, the enterprise value is zero, which doesn't mean it's zero forever. It means turn it around and fix it. And my experience of messaging, I think there's two things, right? The one thing is, to your point, AJ, I strongly agree that there needs to be a conversation about what is the value of equity. Because if there isn't a perceived value of equity, then we should withdraw it from compensation. And I think there's a conversation about compensation that is half formed at this point for many companies, where all of the employees are discounting everything that the company does besides cash, but the company is doing many things outside of cash. And I think there should be a total compensation discussion that happens with the company that includes explaining how equity works and why it's valuable, assuming that all of you are intent on creating value for the enterprise. And then the other thing I think is, at the same time, I can't even for me to go to my team, any team, even the executive team, and say, we're trying to sell the business in 2 years. This is what we need to do. I know that companies have done that. I know that Topo did that. And I talked to Craig Rosenberg about it. And he said, we said we were going to sell to whoever they sold to, Gartner, Forrester.
Gartner.
We understood the profile of the business. We understood how Gartner reported. We started reporting the same way that Gartner did. I feel like your ABM strategy on TrendKite and Cision, was an example of like optimizing for a sale in a very smart way. It's definitely possible, but I feel like for me, I would probably screw that up in some way. And so for me, I'm intent on creating, I mean, it sounds stupid, but I mean it. I'm serious. I'm putting the outcome to the side, and I'm saying I'm going to focus on creating enterprise value. And for me, enterprise value is going to come from first profitability at this size, and then looking for growth levers. But it's not the inverse. It's not, I am unprofitable, therefore I will try to throw more money at the problem to try and grow my way out of it. It is the opposite equation. It is, I'm going to get to the size that I need so that at this size, if we never grow again, we are profitable. Therefore, I've bought myself, theoretically, at least infinite time, but maybe in realistically 10 years, right? I bought myself as much time as I need to experiment with growth, understanding that true valuation manifests itself in a combination of growth and profitability. So but to the point, right? The reason I'm not talking about M&A or any other kind of outcome with my team or with the board is because we're only in step one of a two-step process. Step one is become profitable no matter the size and stabilize the business, which is where we are. And all signs point are green right now, which is great. And then step two is, okay, that's good, but you're not looking for a 10 or 15 times multiple on $2 million of EBITDA. We're trying to go for something bigger than that. So where can I find growth after that? If I was growing 20, 30% with 10, 15, 20% EBITDA margins, meaning north of the rule of 40, and I had visibility that growth was accelerating, it wouldn't even be that I'd have to look for M&A. I get 5 inbounds a week from investors saying, can we invest? I just don't want to tell them our numbers right now. So, the long of the short of it for me is like, I want to design my business for profitability first, growth second, and over a multi-year journey. And I'm confident that if I do that, options will present themselves.
For the record, I am absolutely not advocating for designing and working backwards from a very specific outcome. I mean, I've been at a company that said we're going public in a year, and it did not happen, and they still have not. Well, they went public in 2016, 2018.
Well, that's interesting.
Well, so like Meltwater, they went
the
public.
Effect of that on the team?
It was like in the moment, it was like this very celebratory situation, and then a year and a half later, it just became this.
Yeah, it's.
I know people horrible. They got bought. They went public on the Nordic Stock Exchange, the Swedish Stock Exchange.
Lots of liquidity on the Swedish Stock Exchange.
I'm gonna put STA in Pakistan, see what happens.
This public information, but at like 150 to 200 million in revenue, the market cap was like 400 or 500 million. And it was brutal. A 24-year-old company, so like just super, super brutal all around. So what I am advocating for is no, I agree with Sam, and that was my statement. So Sam agrees with me. Is the options, communicating the options to your employees, and then just giving them the sense of like the big picture. And also, to be fair, Sam and I run very different businesses. We're a SaaS-based business. And Sam talks a lot about profitability. That for any SaaS-based business, that's not, I've never worked for a profitable business, and that's a challenge in itself.
You've never worked for a profitable business?
Yeah, okay, I said it, and now I'm gonna get roasted here. TrendKite was never profitable. No, also to be fair, I've only worked for 3 companies, but
and you had great outcomes. So obviously, there's a very viable path there.
Exactly. Yeah, go ahead. We'll just move on.
You're the only one with a jet, dude. You're the only one with a jet, so you've done well.
Jet.
What about like?
Have you been? That's not a jet. What are you talking
Hey, Sam. Moving on. Asad, go.
Can you operationally talk about that conversation? Because I think that's a conversation that isn't happening in our ecosystem at all, and is a really good conversation to have, because a lot of people are very confused about the value of what they have. And they basically, as you said, they just basically think that the value is zero since no one's talking about it. And so click in more to how you're going to talk about this. Are you going to show them scenarios of how the market plays out and its implications on multiples, and then tie it into strategic pillars, OKRs, that type of thing? How you tying these things together? It's super interesting what you guys are doing.
I'll send you guys the decks that I've sent out like in 2019 when we were doing this. It ultimately was just like, here's different outcomes for our Series A, and then here's the roadmap. And product is the tip of the spear to marketing to sales to CX. Like, you have any delays in those chains and we don't get the things we need to get done in terms of goals, that pushes out the revenue number, which pushes out the multiple, which pushes out the things that we can do from an option. This is why every job in the company matters, why every role matters, and what we should be doing about it. I think at the M&A level, the conversation changes. It becomes a little bit more strategic, and it's really clear. It's like, okay, here's what your options are worth. But, in this market, here's what they're probably worth. Here's what we're working towards. And it's also understanding, by the way, the difference between common and preferred, because employees are not paying the preferred price. And I know it's really challenging to understand, but they have a 409A discount on what that preferred price is. So, like, even if you have to clear the preferred stack, fine. But if you clear the preferred stack, even if you bought the common price at that price, you still are stand to make 4 to 5x what you're going to make.
I literally just had this conversation with my VP of people. Exactly this conversation, exactly those numbers that AJ just said, because again, total compensation, and we're talking about uses of cash, and we're talking about, do people really we had a board meeting last week, and one of my board members said, does everybody in your company have equity? I said, yes, they do. He said, do they understand what it's worth? I said, no, they don't. And if it's going to be part of compensation, people need to understand how it works.
Yeah, that's such a good point. Okay. The last part of this late stage analysis is super interesting as well. So Unicorn growth over the last 10 years tracked computer power growth. They call this the Unicorn software power law. It seems that as compute capacity, capability, and usage increases, unicorns grow as well at a similar rate. So unicorns grew at 30% year over year, which tracked the growth in compute. They decided to try and project what might happen in the future. And so they looked at they based their analysis on 350 quality companies. The growth rate of the last 10 years was 30% year over year. They used 15% year over year. And basically what they came up with was that by 2033, there'll be 1,400 unicorns in the US alone. Sam, I have a question around PEG. So if you were a company that is optimizing for profitable, efficient growth, is going to have a lower gross margin profile, right? They're doing services revenue.
No, wrong.
No,
wrong. Well, they're gonna have a lower growth rate.
A lower
probably
growth
gonna have. Well, I guess it depends on how you calculate.
But like, if
gross
you're
margin.
doing training, like one of the things you wrote about is training, consulting, sponsorship services. So some of that is cost of goods sold. Also, generative AI calls are also cost of goods sold. They are. And so you've got this like margin compression on the gross margin side of things. And it just got me to start thinking, like, maybe in the future there aren't going to be that many unicorns. Like, maybe what we're building towards is really good companies that are worth hundreds of millions of dollars, but there might not be 1,400 unicorns because we're building different types of companies, optimizing for different things. The valuation mechanisms would be different. Like, what are your thoughts on this downstream effect of building a pet company?
I think you're making... The only thing that we historically have tended to underestimate is the overall growth, the boon of economic productivity writ large, as more and more lower and middle class populations around the world come online and become middle or upper class. Now, the other macro trend that is moving in the other countervailing direction is the fact that replacement rates in modern economies are, birth rates in most modern economies are below replacement rate, to the point of the article you sent us about China, who seems completely, they're in a lot of deep trouble because we're not having enough babies. But generally speaking, over the last 100, 200 years, now, again, it correlates to human population growth. So it's hard to say that this trend will continue inevitably, because you do need more, you need kids fundamentally.
Yeah.
You need people to buy stuff for the economy to grow. And you need that picture of the future to be optimistic, because the economy will grow, which is because there will be more people, which is why everybody, this is an aside, but everybody that's ever talked about overpopulation is absolutely 100% wrong.
Okay.
Overpopulation is not the problem. Underpopulation, particularly in advanced democracies and advanced economies, is actually the real problem and the real thing that will destroy the global economy, which is a way of saying, like, right now there's so many old people in all advanced economies, and it's all going to be a small number of young people supporting all the old people.
Yeah.
And that is the thing that will kill global economic development. So all of that is to say, but generally speaking, putting that aside, we all tend to underestimate the growth, the power of human productivity improvement. So that's one thing I'll say. On the other hand, I tend to agree with you, right? I agree with you that, I mean, this is sort of like the double-edged sword. The first part, which is why they said that the capital efficiency, in the same report, the capital efficiency of enterprise businesses has materially declined, right? And what is another way of saying that? Another way of saying that is the whole premise of SaaS is being called into question right now, because, again, as we've said repeatedly, the theory of SaaS is that you spend a lot of money to acquire a customer, but they stick around for a long time. And the reality is that most people change vendors much more often than all of our assumptions would imply. Most people most people's mind is harder to change because it's harder to get their attention, but then they seem to be changing it more often than we expect. So the fundamental premise of SaaS, which is that there's profitability in the out years, is being called into question, because markets are moving so quickly that you're constantly having to fight back competitors, innovate, build new products, etc. Therefore, you never get to profitability, which is a way of saying maybe you're right. I guess very long-winded way, but also me trying to sound smart by putting in a bunch of like random and adjacent points. But fundamentally, the point of profitable, efficient growth, which is the point that you just made, Asad, is that we're interested in positive operating margin businesses and positive gross margin businesses, and we're less focused in that world on the type of business that it is and what the multiple it commands, because the balance sheet doesn't care. And if it throws off $100,000 in profit, then maybe we want to do that because we need the $100,000, as opposed to saying we don't want to do that because this other business is losing $500,000 but has very high gross margin, in quotes, because we're calculating gross margin in a strange way.
Super
So listen, the fundamental point that you're making is, I would agree with, right? Which is, that's the whole point. The whole point of all of this discussion is that which is the point that AJ just made about equity value, which is the point about all of it is a way of saying, hey, there's a capitulation and an acknowledgement that we're in a different world.
Yeah.
And in that different world, the dynamics of that world are that it might take longer to get to liquidity and longer to create enterprise value. But the benefit of it is that we get to control our own destiny, because our companies will belong to us and not the investors.
That's super interesting. AJ, you have probably done the most seed Series A investing out of the three of us. And so can you reflect a little bit on the advice you would give somebody who is preparing to go raise a seed or Series A round, let's say a couple of years ago, versus now with all the lessons and all that we've seen play out and this data that we've just reviewed? Do you fundamentally change some of the guidance you're giving these founders?
I was Sam earlier was talking about the LP return capital, the management fees really high, and for Andreessen, or I don't even know who he said, and I was like, yeah, I should check my companies and how I'm doing. It's been 7 years. I've done 35 angel investments over that time.
There's some great
and
names in that portfolio.
There's a good. I think we'll see. SeatGeek. They're talking about
Are
going
you allowed
public,
to
and
say
they're
the
not.
names? Like, you say SeatGeek, but you don't say
I think we should push his book. I mean, like,
I'm
these are
pushing it
great.
right now.
SeatGeek is
Everyone
great.
needs to go. If you're going
Who's
to
the
that
most
Taylor Swift
impressive
concert,
company you've invested in?
you need to SpaceX.
There we go. Like, you don't say that,
Oh
you
my
say
God.
SeatGeek.
You're going to get secondary from SpaceX. I mean, don't they offer secondary every year?
SpaceX. I was just talking to my financial advisor about this. So SpaceX is up 6x from where I invested in it. So I don't know. That was one. It was a flyer like 5 years ago that I was like, yeah, that's cool. I'm invested in SpaceX. I could have invested into
remember.
OpenAI.
You got the message
Yeah.
right after that, right as soon as we wrapped up the podcast. You got the message
with Altman. Yeah, like I don't even know if I can say these. I won't say their valuation.
Well,
I don't think I can.
I was
do that.
looking at OpenAI's valuation compared to.
Did you get it from Carta, by the way? Because that's where it was on the secondary market. I'm kidding. I'm totally kidding. Please, Henry.
By the way, this is such a side topic, but I'll talk to people, and we're talking to clients, and they're cagey about their valuations, and I have pitch books, so I'm like literally looking at the valuation. It's like, guys, like this is publicly available information. It's not as secretive as you think it is.
Yeah, I know.
OpenAI is actually, they had, I think, a 54x type of multiple on their revenue. Perplexity has 150x multiple. So if you think about it, in the space of AI, OpenAI is fairly priced, it seems. But yeah, going back to the question, like,
Asad, I'm a paper unicorn. Here we go.
I'm
just kidding. I'm kidding. I'm totally kidding. The way I think about this is that it's a very small portion of my investments. I do it to learn. Sam's point around like putting it in the market, you probably are going to do better. I actually have that point of view, just more generally, because I talk to founders that I really believe in, but they're mostly in Philadelphia or Austin. I have a handful in LA. They're people that I know that I want to root on, and I want to keep that professional relationship. And so, like,
are you changing what you say to them? They're like, "Hey, AJ, I'm going to raise my seed round."
That was your question. Yeah, I'm first off, I'm not actively investing, and I haven't been for a year and a half. Like, I hit my quota, I hit my max. I tracked it in Quota Path, and I can no longer invest in any other. My wife and my financial advisor tell me I have to stop saying yes to everyone. So if you're gonna reach out to me, I'm sorry, I'm not active right now. But it's challenging because it's what I've heard in the market is like, hey, I just need X dollars, $250,000 to round out this round. Do you know of any angels? I'm like, I honestly don't. And I've done the intros where I've done like the double opt-in, or not double blind, but double the opt-in. And it hasn't led anywhere recently. And so I've just like held off. I've advised in pitches for folks that are going to partner meetings that have ended up well. So I know that deals are still getting done, but my network has slowed to a trickle in terms of the angel investment. And that's a shame. I strongly believe that ecosystems like in Austin or like others survive because of the angel investment back into the community. And I'm not alone in like the lack of investment in new software or even AI. Like everyone's kind of just like chilled on the angel world for AI. We just don't know what it looks like yet.
Yeah, good point.
Sam, I don't know if you have a different opinion.
Well, I mean, I think everybody's chilled as the market is, we all feel a little bit less wealthy, particularly those of us going through different stuff on the personal front. So yeah, I'm not writing a ton of checks either. Although, as we've discussed, I was happy about the return of Solana, although it seems to be receding. But I did sell off a chunk.
There you go.
At the very top. Like I timed it.
Let's go.
Yeah, see?
That's amazing.
As the only one on this call that invests in crypto.
Well, you do have 4 Bitcoin. I think it's time for shout outs and wins of the week. All right. Who goes first? AJ,
Not
you
me.
go first.
I've gone first every single week.
You go first. You go first.
I want to shout out John Mark Shaw, Sam's coach, who then I started working with. It was just something happened over the last few days where I've introduced a couple of people to John. He's actually working with my older brother now, so he's in our fam. And I caught up with 3 or 4 people that he was working with, and all of them have had like remarkable changes in like 3 months, like remarkable. Like you can hear this shift in their voice. You can feel this change in their demeanor. One of them is on track to double his net worth in a year. He's 40 something years old. What he's built in like 40 something years, in a year he's going to double it. And a lot of it is the push that John is giving him. And then last night there was a post from one of our CEO Pavilion members who I don't even know, I forget his name, but he'd asked for a recommendation. I'd introduced him to John, and he had like this post, this 100x return on investment. This is the best guy ever. And so I just realized, John,
was this on LinkedIn or
LinkedIn? Yeah, on LinkedIn.
Amazing.
I was just like, John's so good. Like, John is really, really good. And obviously, he's had a remarkable impact on Sam's life. He's really helped me a lot. But it was just so cool, when you make introductions to people and it
Yep.
works really, really well. I used to feel
Love it.
that way about Revenue Collective initially. Every time I introduced somebody there, they would call me back and be like, "This is the best thing ever." And John has that, and so just kudos to John for being so good.
That's awesome.
Yeah.
I'll go next. You're listening to this where I'm already. If you're listening on Sunday, then I'm in. Me and AJ and maybe Asad, we'll see, are in Scottsdale. And if you're listening on Monday, then I'm in San Francisco with Kathleen, Jocko, and the GTM Consortium team. But my shout outs are to a lot of the members of the CEO Alpha group, the first group of CEO Pavilion members that are going to be in Scottsdale. AJ and Asad are members. Jen Spencer, CEO of SmartBug Media, she was a member of the first CRO school and then made her way up and got promoted to CEO. David Spitz, we all love Spitz.
Yeah, David.
Brandon Barton from Byte, who started, I first got to know him as the VP of Sales at Resi. Tom McCarty, the CEO of Officeworks Software. I don't know if Brian Litvak from League Apps is going to be in Scottsdale. I hope that he is. But and I hope Seamus Ruiz Earl, Stephanie Cox, hopefully from Lumavate. I'm not sure if she'll be there. I haven't heard from her in a little bit. But all of these people are part of the 100 and today it's 115. Maybe by the final registration, it'll be 125 CEOs that have just joined us in Scottsdale for an incredible couple of days. I'm just so excited to see them. I'm so excited to talk. There's something about, and this came crystal clear to me, and this is why we've added a half an hour to our top line recording so we can expound a little bit more and wax eloquently. But I was sitting around. Our first big get together was a Hamptons weekend that AJ was at with Ange. I think it was a year and a half ago. So it was the summer of 2022. And we were sitting around, it wasn't a campfire, but it was sitting around a table, and we were having drinks. It was like 10 p.m., 10:30 p.m. And you look around the circle, and Seamus is sitting next to me, and AJ's sitting over there, and Connor Love is sitting across the way. And every single person, their title is CEO. Every single person. And there's something really, really magical about where it's not, well, I'm president of my life insurance, and I work for Coldwell Banker, and and I work for I do sell D&O insurance, and I'm a contractor. But like literally every single person runs an organization of some scale. But you're there with them, not just at 10 a.m., but you're there with them at 10 p.m. at night, and you're sipping a drink, and you move in and out of personal and professional conversation, and you just feel that support of people that are facing exactly the same challenges and confronting the same obstacles and sharing in the same victories as you. And it's really exciting. I can't wait to see everybody. It's going to be a great event. I want to thank Kathleen and the entire events team, including Maddie and the Planwell team, for helping us organize it. Great speakers like Jason Lemkin are going to be there. Matt Blumberg's going to be there. Jocko's going to be there. Sangram's going to be there. So it's going to be awesome. And I can't wait.
I love that. The CEO Pavilion in Miami, we had a dinner. You didn't come to the dinner. You were busy, but we had a dinner after the CEO Pavilion event. And it was the same feeling. I remember AJ and I were sitting next to each other. It was the most fun conversation I'd had in a very long time. Like I was like, thank God I'm sitting here. And it was just this amazing energy. So you feel it at all of these events. Brilliant. AJ, what's your shout out?
I get it. I'm the bond that ties everyone together. I get it, Asad. I mentioned Jared. I didn't mention him by name, but my financial advisor, Jared Torin, I've worked with him for 10 years in Austin. He's helped me along the way, and I had dinner with him last week in Austin, which was just fantastic. I'm good friends with him and his family and his wife Holly now. And we were just like reflecting on the years over. He's just been such a partner for Ange and I in terms of all of the things. It's not just the financial advice, but honestly, from a life standpoint, he's been awesome. And he listened to a couple of Topline episodes early on, and I told him he has to listen this week. So now he doesn't really have a choice. But I told him, hey, look, as soon as we made the change to Asad giving us a docket, the entire
oh yeah,
it's changed overnight in terms
it's
of
good
the
now. It used to be
it's
not
really
so
good. So the content's fantastic, and I think he would really enjoy it. And I think he'd enjoy this week's episode. But also, I'm giving him a shout out. So thanks for all your help, Jared. It was great seeing you. Great to have dinner last week.
What a
All right,
great
everybody.
episode. That's the episode.
Episode 41 of Topline. Give us 5 stars in the stores where you get your podcast. Please tell a couple of friends. I still want to give $20,000 to the top listener.
Yeah.
Something. Tell 5
I don't.
friends.
I'll buy you a
Otherwise, we'll talk to
Ferrari.
I'll buy you anything you want. I will do anything for money. I'll be very gentle. We'll see. We'll talk to you on Thursday for Topline Hotline. Thanks for listening.
Bye, everyone.
Bye.
Bye. This episode was brought to you by Affinity for Salesforce. Automate the creation, update, and enrichment of Salesforce records and use your network and relationship insights to find, manage, and close more deals. Check out Affinity at go.affinity.co/pavilion.
Thank you for listening to this episode of Topline. To learn more about the trends, news, and developments impacting the world of B2B SaaS, head to joinpavilion.com, where more than 10,000 of the world's top go-to market leaders go to achieve and unlock their full professional potential.